Hello everyone, this is Bella. Welcome to my series of instructional videos on price behavior. In the last video, we learned the basic K-line pattern. If you haven't read it, you can go to the previous lesson first. That is to say, learn to observe how the main funds operate under different market conditions. This is the last part of the basic teaching. In the next video, we will start to learn the punishment state and structure. First of all, let's think about a question: why do market prices go up or down? The answer to this question is very simple. I believe many friends can answer it. While many people know the simple truth that when buying demand is stronger than selling supply, the price will rise, and when selling supply is stronger than buying demand, the price will fall, few will feel the changes in these forces in a K-chart. Next, I will take you in the K-chart, feel and understand the market in different states, how to operate the main force of long and short. I take the most familiar Bitcoin trend for example, here to note that Bitcoin is still the dominant price of the spot market variety. The bear power here, more is the main selling hand spot flat single caused by, but in order to facilitate understanding, I will take it as the main long short full game market. It makes it easier for you to learn to read charts of other markets later. Let's go back a year to see how this whole strong bull trend has played out. First, let's look at how the market price changes at the beginning of the trend. How do the bulls and bears participate? There are many different opinions about where last year's great bull market started. Some people think 10,000 is the starting point for this bull market. Some people think maybe 14,000 is the starting point for this bull market, and some people think maybe 20,000 is the starting point for this bull market. So let's look at some of the details. We can see that when the market first broke 12,000, we can see from the chart that there are many non-trend K-lines and some contrarian trend K-lines. When the K-lines overlap, it indicates that there are bilateral trades, and the market is not clearly dominated by one side. Then what I mentioned later is these strong bulls and strong bears. They don't mean that one particular person, one major player, may be strongly bullish in one session and strongly bearish in another, but what I mean by strong bulls and strong bears is that in the current market, people who have been buying heavily have decided to sell heavily. I'm talking about the current forces in the market, I'm not talking about one major force that he's going to do, so let's go back to the K-line. Why is this segment going up? It's hesitant, it is an overlapping arrangement of K-lines, and every time it rises, it will retreat a little and rise a little again. That is because during this period of rise, the main forces of the market have different views. Some of the main forces may think that the bull market has started here and should continue to buy, but some of them think that the bull market will start only after it exceeds 20,000. It's still bearish until it gets to 20,000, so he's going to short it when it gets closer to 20,000. Then we can see that when the price is close to the 20,000 level, there is a pullback and pause. How does this pullback pause come about? First of all, it must have some long in liquidation, because maybe the short-term bull thinks 20,000 is his profit target. As for the back of the market can break the 20,000 level, he temporarily wait and see that the pullback also has a part of the strength of the bear as what? Some bears think that the 20,000 level can't be broken, it can form a big cycle double top with the previous 20,000 high, so he is trying to short, but at this time the main short institutions must not be large entry. Because smart money, never in the first bottom or top of the entry, they must see the strength of the follow-up back test, whether it represents the exhaustion of the strength of the bull. If there is a bull energy exhaustion signal in 20,000, they will vigorously enter in the later test. Then let's look at the subsequent price performance. The price broke through 20,000, the historic key level of 23,000, before pausing. This tells us two very important information. First, in the first pause below 20,000, the main players involved in the attempt to short have stopped their losses. because they knew that when this 20,000 was breached, there was going to be a very rapid rise. The smart money will not compete with the market, and when it finds its mistake, it will immediately stop its losses. Second, the institutions that have been long in the market see the key signal that 20,000 has been broken. They know that the real bull market has begun, because there is no resistance level above 20,000. They start to be more aggressive. The bulls keep buying into any small pullback, buying into any breakout, while the bulls in the market who want to participate in the short market don't rush in at this point. The smart money doesn't go against the trend and only comes in when the price moves to a logical place. For weak traders, what we call small retail investors, most of them haven't seen the trend yet, they're still on the sidelines, and some of them are even shorting because they think it's gone too high. We can recall that when Bitcoin first broke 20,000 during this rally, in the market community, most people said they had no idea what was going on, were afraid to buy, unsure of where the market was going next. There are even a few people who are more and more bullish, more and more bearish. And in this period of rapid movement, the account is blown up. How is the early price performance of the strong trend? We can see that in this period of rapid rise there is a lot of bullish trend K-line, no or very few contrarian K-line. We can see that when the price falls slightly, there is a lot of buying support, so there's no significant pullback. And that's what you see in the early days of the trend where you have strong gains and only the major players are buying consistently. Ordinary weak traders haven't stepped in yet because they don't understand what's going on in the market. And if you recall, during this rally, there were a lot of institutions, including a lot of public companies, that were saying that they started investing in this digital currency during this rally, and the community at that time was retail sentiment. It also means the cows can't be here, it's rising too fast. There were even a lot of people shorting, and if you recall, that was the state of the market. As the trend plays out, the minds of major players in the market are changing. We said earlier that in the early surge of the trend, the main bulls will buy on any pullback, they will buy on any breakout. In short, they have been buying continuously to push the price up. But why did the price movement stop at 40,000? Because some of the main bulls are starting to close out their positions, because even if they went from 20,000 to 40,000 they would have doubled, and if they had gone earlier. They are partially unwinding their positions and are only willing to buy into deeper pullbacks. They were in this rush, and in the previous rush, they bought into any pullback, and from now on they're only willing to enter into a deeper pullback. For the main short sellers, they are also trying to play the market. Why? Because the price moves to 40,000, it's a doubling of 20,000, it's a resistance level at the psychological level. So short traders, the main short sellers, they try to get involved. But they don't get involved in a big way at this point. Why? Because the structure of the bull market is still so healthy. As I said before, the main players, whether they're long or short reversals, they don't load up at the first pull, they wait for the market to test this point later on, and after the test is weak, then they slowly add to their positions. That's where they slowly add to the short position, if there's a weakness. So for weak traders, small retail investors, they see a downward correction. But they think it's a reversal of the trend, they think the bull market is over, and they keep shorting it, and they keep shorting it. But for the smart trader, there is no better time for the trend to officially follow the main force into the long side. Including Mr. Luo, many traders, many smart traders are in this period of time to enter. We can turn over the video of Mr. Luo. Days may also at the end of the month when the teacher let the position of a lot of currency. At the time, a lot of people were saying, this bull market is over, this bull market can't happen, and so on. But if you look back now, this point is technically the best entry level for participation. We'll summarize it here. As the trend runs, the main bulls start to unwind some of their positions. Only willing to buy into a deeper pullback, the main bear force is starting to try to participate in the market, So what is it doing online? It's a simple pullback. You can think of it as a 2-down pullback, and if you underline it you can think of it as a 3-down pullback. It's a very simple trend pullback. The market is starting to show a trend K. After a simple pullback, prices quickly return to their original trend direction. Let's focus on this positive line, which is a strong break from the previous band highs. After the breakout, prices take a brief pause before continuing to rise. Every price break above the band high brings new buying power. Why? Because at this time, the main bull market, they know that the bull market structure is very complete. Every time the band point breakthrough is to add positions is a good opportunity to enter the opportunity to make money. And at this time, for retail trading, any participant who is not particularly stupid should be able to see that the market should actively participate in the trend direction in the midst of a bull market. We can explore further and connect the highs and lows of the previous wave to the end of the correction. From the end of the correction as a starting point, we can see the rise of the wave. Compared with the rise of the previous first gear, its energy is stronger, indicating that so far, the energy of the super trend has not weakened. The bull market structure is still very complete, at this time is still in a strong bull market. So let's look back. So why is the price going down here? Well, it's very simple. It's just that I've drawn these two trend lines, and these two trend lines are equal, and we can see that the target point for this rally is the same as the target point for this rally, and that technically becomes some long liquidation, profit liquidation. It's also going to be an entry point for some bears, and once again prices have had a simple pullback, and this simple pullback. And this simple pullback, if you look at it on a small cycle, like if you go 4 hours, you can see that it's a standard wedge pullback, and if you're interested, you can look at it yourself, but this simple pullback doesn't even test the previous band, it leaves a gap in the previous band. So what does that tell you? That means that traders who haven't entered the market at this point, or who have closed their positions on it, are buying aggressively here. Everybody knows that the bull market has come, are buying aggressively. Why many investors and traders on the sidelines? At this price, active and urgent entry, because they have seen the front from 20,000 quickly rose to 40,000, after a simple callback from 30,000 quickly rose to 60,000. Who knows this is already a trend? They urgently want to join this round of trend in the callback. They feel that if they don't get on board now, they won't be able to make money off the bandwagon. The rise since then has also been rapid, but here's where the price problem arises. Then some people would say, well, isn't that an afterthought? You see the back has fallen. You say there is a problem here. It's just that a lot of people don't even have this basic technical analysis. As I said before, in a healthy rally, every time the price breaks above the previous band point, it leads to continued buying by bullish forces because they think the bullish forces are intact and healthy. They know that buying and selling can make money immediately, but we can see that after the price breaks through the previous band point, it immediately closes a short trend K line, which is the pause of breakthrough, followed by a longer negative line. That is, the failure of breakthrough represents the failure of breakthrough without follow-through power. Why there is no follow-through power? Because the main long at a very low position, under 22,000 30,000 already participated, they began to profit liquidation at this point. They no longer buy after the breakout, but after the breakout to close out the hands of multiple orders to sell the spot. And at this time, the main short institutions, they will soon be able to accurately capture the signal of the lack of momentum. They will increase efforts at this time to lay out short single. We continue to see the trend behind. The market carried out a simple round of correction. The extent of the correction is relatively healthy, but here to buy is not the main institution. Or the main institution in here to buy interest is not high. Why? Because they had just sold out of their previous high, most of the spot, they had to come in and buy more at lower prices. So if we look at this rally, it's anemic, it's filled with a lot of non-trend K-lines, like the cross star or the short trend K-line, which is also a sign that bulls are no longer actively participating, and the breakout from this rally is still a failure. We can see that compared to this rally breakout. The front band peak still does not bring follow-up buying, because it has been in the end of the trend, long built in the low position, has already made a big profit. They break the front band point each time, in succession, to sell their spot. And this breakout failure is 2 consecutive breakout failures on the previous band points. It greatly increased the confidence of the main bears, and the main bulls saw the 2 consecutive negative signals. They know that the trend is wrong, either the trend reversal, or the trend for a large long-term pullback. Assuming you now hold multiple orders, you know for sure that a long correction is coming, so what are you going to do now? It is very simple to sell all the goods in the hand, and then the price fell rapidly. We can see that this is because in this round of decline, there is no main body without the main participation. The main force has sold all his goods in the hands of the above, only the short institutions in the continued entry. The band low is worth our attention. This is with the appearance of the large positive line, which tells us that it is a false break against the previous band point. Here is a signal of the main bulls entering, representing some of the main bulls, willing to enter at this level, to continue to go long. But then the K-lines that we see in the market are all very weak K-lines. They're all overlapping K-lines with cross stars in them. There's a contrarian bear trend K-line. Even if there is a bullish trend, the K-line just overlaps with the previous one. It tells us one thing: the main players are not willing to buy anymore. The market is in a trading band here, and the market is hesitant, and as the uncertainty increases, the main players who are already in this position, they are also aware of this fact. There is no other force, no other money willing to continue to drive prices up. So they give up their defense of that position. When the bulls exit the market, the main bear forces pick up on that signal and go into a sharp decline. The weak traders, what do we call technically immature retail players, do? So when they do this fake breakout, they don't recognize that it's a sign that the bull trend is running out of energy, and they keep holding on to their multiple orders after the breakout entry. If you keep carrying it, some of you might get out of the market on the downside. What about some of the weaker players who are going to get in here at this price, and there's no problem getting in here? This down could bring about a trend reversal, or it could bring about a sideways range, so there's no problem getting in here. It's all about how you manage your orders afterwards, and we can see that in the rally here, there's no follow-through. It creates a trading range, uncertainty in the market is increasing, and if you're a smart technical analyst, you're going to be sounding the alarm here, and if there's going to be any movement from time to time, you're going to run. Then we can see that when the bulls give up defense at this support level, also give up defense, the price is tumbling down, then I think a lot of the retail traders involved in the long here, he did not stop the position, did not recognize the support level is invalid signal. Then we finally summarize this round of bull trend. Finally, how to turn? First of all, it should have a false break. Successive false break symbolizes that the main bull in the breakthrough choose to leave the market to close the position, rather than continue to participate in the long. Second, he gave up defense at the important support level. The main bull is not willing to continue to buy at this level, only willing to buy in a deeper position. There is no bull force to follow up. You just have to reverse what I just said about the long position. I won't repeat it again. What I need to talk about is the trading area. The trading range is an independent state of the market. First of all, both bears and bears in the range believe that this range is worth trading. The main bulls are only willing to buy at the bottom of the range and take profits at the top of the range. The main bears are only willing to enter the range at the top and short. When the price moves to the top of the range and the bottom of the range, there is no continuous follow-up force, so the range cannot break through all the time, and it is easy to form a false break. Then I mark the points of false break in the graph. such as the above means that when the price breaks the range, no bulls are willing to continue to buy, the profit has been scattered, only short is willing to continue to enter at this price, then he below the angle is not good. On behalf of the reverse, short positions at this price has been profit liquidation, only the bulls are willing to continue to enter to trade. In my many years of trading experience, including the fact that you can do your own recovery, I will tell you that there are a lot of false spikes in ranges. And you can only look at the trend when the range is clearly broken, and until the range is clearly broken, you have to keep trading as a range. A lot of people didn't understand that, even if some people understand this point, it is difficult for him to do it in the actual trading. He will go to the entrance to make a breakthrough in every fake breakthrough, so that it will be lost in the curve. Let's talk about another knowledge point, about the phenomenon of a pressure vacuum in the market. We can look at the figure. Let me remove the last. If you look at this negative line, the negative line I'm referring to here is a long negative line. I talked about a trend K line in the last video. If it has a longer physical part and a shorter shadow line, it has more energy. So guys, when you look at this short trend K line, do you think it's a sign of short strength? Let's forget about the answer and compare it to the other short trend K line. Just this one and this one. Let's take this short trend K line on the right and compare it with the three on the left. I can tell you the answer. The three short trend lines on the left can represent the strength of the short trend. The short trend on the right, the K line, represents the energy depletion of the short bear, which is caused by the vacuum of buying pressure. What is the vacuum of buying pressure? Let me explain it here. First of all, the background here is a trading range, so let's say you're the main bull, you see this proven trading range and you're ready to go long, and you see prices going from the top of the range to the middle of the range, so what do you do now? Because you've seen this rapid movement, you know you can get as many orders as you want at the bottom of the range, because the price has been falling rapidly. When you wait for the price movement to the bottom of the range, you will not participate in the entry. The main bulls at this time is on the sidelines, did not participate. That is because the market at this time, the lack of strength of the bulls, it is easy for the bears to push the price down to the bottom of the range, but this pressure does not represent the strength of the bears. It's because of the lack of long forces in the market. A lot of immature retail traders who are weak participants, they see this big negative line. If he holds a long order, he immediately flattens out. If he's not yet up, he sees this long short trend K line, he thinks the short trend is coming, the range is going to be broken, he immediately went short. But in fact the price stopped immediately. Why? Because the bulls have been waiting for the bottom price to enter, waiting for the bottom of the price movement to participate in the market. This kind of vacuum can easily occur in a trading range, as well as when prices are moving against well-defined support levels. It is important to carefully identify and not get caught up in this long trend line. Okay, that's all for today's teaching and sharing part. I hope you can carefully learn and understand and master this ability in combination with the review. Feeling the strength of the multi-year force is the most important part of price behavior analysis. As I mentioned several times in the last video, don't care too much about the appearance form, but should deeply understand the nature of the price movement. Many people, when they were learning trading, became addicted to this head-shoulder top and bottom double, top and bottom double, but did not pay attention to the nature of the market movement. They did not know why the market formed this shape. So he always fails in this form. If you can feel the change in the long/short volume in the strong trend launch phase, the trend run phase, the end of the trend versus the reverse phase, and the trading range, then you have a head start compared to other weak trades, keeping up with the pace of the main force. Some of the novice traders may be competing, he said. The main force is to get the new product off, the main is to harvest retail investors. How can we make money together? So let's look at a recent example. At the bottom of Bitcoin's trading range, there are 3 clear signs of movement. The first arrow is a single K reversal, and the second arrow is a second entry. It is also a single K-line reversal, and the third line is a double K-line reversal pattern. A false break at the bottom of the interval is a form of entry, a form of long, and an ecology of many. Main institutions are also in this position. To do more, then I ask you, my K chart can see this form. Meaning that retail K chart cannot see it? Didn't he use a different dark map than I did? The second main point in these positions, to participate in more, a clear threat to retail investors. Say you dare to do more, I will kill you. Have this? Not at all. Does the main force in the long time to communicate with the exchange to let these retail investors do not let these retail long there? No, if you want to be long, you can be long in these positions. Then why does he dare not to be long in these positions? Because the first, he cannot recognize this as a multi-type. It does not understand technical analysis. He does not understand the false break at the bottom of the interval is a long entry form. Most weak traders' technical analysis ability is very poor, such as the naked teacher in these 2 points also recorded a video. Let everyone participate in, say, time to go long. I hope everyone is buying together to make money. At that time, I remember a lot of comments were like, you're a dick, you're a bear market, and you're still letting people buy, right? You don't have any technical analytical skills. And what happens then? These people must have gone empty. The second point is that there may be some traders. He recognized the long pattern, but it is afraid to trade. He thinks the price has fallen too fast and too scary. He is afraid to participate in the weak market, even if there is a strong long signal. What is the problem of this trader? His problem is that he's playing the market with his emotions instead of believing what he sees, and even though he sees that it's time to go long, he's afraid to do it because of his emotions. He's playing the market with his emotions instead of logic. Finally, I'll talk briefly. Recently, I talked to some novice traders in my group, and I summarized some of the most common difficulties that educators in mainland China face in learning and growing up. One of the most common problems is that in the early stage of learning trading, when we look for courses and books on technical analysis, it is difficult to tell whether it is a real thing with value or a fake trade. Many friends learn wrong trading concepts and trading techniques in the early stage and believe it to be true. Although he worked hard for a long time, he ended up losing a lot of money. I asked them what systems they used, and they all turned out to be something like a moving average, something like MACD, kinetic energy, something like Fibonacci perfect, something that, to an expert trader, you can see at first sight is a perfect, efficient, and unproductive analysis system, something that is only analytical and not suitable for trading. The financial system in mainland China started late, and the mixed environment of the financial investment and education industry cannot be changed for a while. Whether you can learn the correct theory and technology at the early stage of trading depends entirely on luck,